I've got a number of things to that end to discuss today. Let me just check the chat really quickly here, because now I'll have to do that. Let's see. Yeah, Chris. I like to have Henry on these, and he writes great market desk notes. So now Brian and I have had to pick up extra days because normally the three of us share those duties. There are other people I could pull in to do it. We've got some longtime veterans who could do it, but they're busy with other stuff. So I'm trying to do as much as possible here. Barry, to your point, are we at record days above 6? What that means, if that jargon doesn't make sense, if you're new, is there's Edge is all about demand and supply. We take advantage of demand supply imbalances, and you can do it over longer periods of time. You can do it short periods of time. And yeah, we did. At 6.1, today. Maybe it was yesterday. I think the record was yesterday, actually. But so it's a record number of days consecutively where the demand level in the market has been above what we call the red line. The market tends over time, if we're talking about the S&P 500, to trade between 4 and 6. And if you take a long-term average of that, it's about 5.5. And if the market is consistently 5.5, what will it do over time? Well, it'll rise. And that simply reflects the fact that people buy growth and value. And if you had a 10-point scale and growth stocks tend to spend more time closer to 10 and value stocks spend more time closer to 5, and they both bounce below it, you average that out, you'd arrive at 5. If there are net inflows into the market, it's going to be above 5. And so that's what Barry is pointing out. We have set a record. I mean, it tells you this is an extreme outlier. These are unusual conditions. And if you're new to Edge during this particular period of time, it's been different. Under normal, predictable circumstances, we spend a lot of time talking about daily trading ideas. Let's just go look at daily trading ideas, find our high probabilities, take our 1 to 5 day gains, modulate longer term portfolio exposure to the market based on where the demand supply balance is. That's what we do. And look, it's very effective. I don't think I have it up. I don't, but I've running a low volatility basket this year, really effective. Large caps, and buying fives with a 5-day downtrend in supply and selling them when demand drops below 5 or supply rises more than 10%. That approach has created a very nice basket, and there'll be 2, 3, 4, 5 items to sell every day, 2, 3, 4 items to buy, and it's year to date it's up 10.4%. That's a nice long-term approach. Is it crushing? No, but that's pretty good compared to SPY, which is dead flat for the year. So that's a long-term use of the demand-supply balance. Then shorter term, I'm going to talk a fair amount about this because I get a lot of questions about how do you determine if you're going to go long or short the market and use some leverage. And the reason I've done this more here is because it's unusual. These are unusual circumstances. And so I will talk about that a little bit. Really quickly, one housekeeping item. Thank you to the several of you. There was a handful of you who over the weekend said, hey, you're missing data. And interestingly, neither the supplier we use for just high-low, open, high-low, close, market cap, a number of other things, an outfit called Quote Media. I mean, there are all kinds of suppliers. We could use IEX. We buy data from S&P. We could use their data. These guys we've used for a very long time. I've had a relationship with them a long time, and they're responsive. They didn't even know. I sent a note to the CEO and said, "You're missing data. It's mission critical data for us." And it turned out to be in large caps. There were a number of situations where the activity included Microsoft, Meta. It was only about 23-ish tickers, but there's been so much activity. And you look at it and say, well, you didn't see it in the price or volume activity. You looked at Microsoft, you wouldn't say, well, I don't see that there's heavy volume. Are there more trades per day? Is there something happening in the shares per trade? Didn't see any of that. But they had overflow errors. Those of you who know database systems, when you have a field that expects to be able to accommodate a certain amount of data and the data boundary exceeds it, we encounter it on occasion. The data don't populate. So that's what happened. Solve the problem. Got to, it's now we know what to look for, and we create alerts for those things that we know. But anyway, that's what happened. So that tells you behind the scenes there is a lot of activity occurring, and this is what I talk about often in the market desk notes, that there is there risk management things occurring in the market. And here, that's a good kickoff point. I'm going to share my screen that may not be evident on the surface. But the demand supply balances will generally tell us. I happen to have Workday up here. But here's what I mean. The market, and I write about this a fair amount, this will be just a point of understanding why the market does what it does. Why wouldn't, if tariffs have been vacated, why wouldn't the market be up 1,000 points today, the Dow? I mean, if that is the risk hanging over the market, why isn't the market sharply as it was? And can I? A lot of these things are inductive reasoning, perhaps more than deductive, because you have to take what is known and arrive at something that is unknown. And so what I conclude is in this market where we have 3,850 ETFs and most of the market concentrated in this group, mega caps. I had 2 conversations this week with big ETF platforms, and we were talking about this, how it's a very crowded market, ETFs. Most of the money is in mega caps because those are the things that you can get into and out of, and that will create the benchmark. The S&P 500, 500 stocks, it's basically 90% of market cap, just like 90% of ETF assets are in passive or in large cap stocks. 65% of equity assets. If you looked at it, I had a lunch meeting with some folks who run managed accounts for us. The equity components of those models tend to be in large cap blend. I mean, it's a concentration issue in the markets. Getting to the point. Here's your core takeaway. If you think about why does the market do what it does, and the whole basis for being able to me, trade and invest successfully depends on this. Under a regime where everybody's following the Benjamin Graham methodology, a mentor to Warren Buffett, where you're finding great companies at good prices, then you have to be good at finding great companies at good prices. In a stock market that is dominated by exchange traded funds, where the principal mechanism is moving stuff back and forth, and then you and I trade these things called ETFs, and underpinning them is a basket of stocks owned by BlackRock or whomever, and those are moving back and forth. What happens when prices change after the movement? These are things you have to think about. If Morgan Stanley gave 10 million shares of Salesforce to BlackRock yesterday in exchange for shares of a tech ETF, and then overnight the price of CRM moves dramatically, what do you do about that? You might say, well, what difference does it make? Well, the tech ETF is supposed to track, among other things, CRM. And the value exchange was predicated on the value of CRM at that time. They have to be equal. Say $10 million worth of CRM in exchange for $10 million of shares of an ETF that Morgan Stanley then will sell to the public. Well, if the prices move, there's an issue. And because there are unknowns like that, both parties, BlackRock and Morgan Stanley, are going to do things to mitigate the risk of the unknown with baskets of options and futures. What if either thing changes in value? Well, I'm going to hedge it, in effect. Doesn't make them hedge funds. It makes them users of insurance. And that stuff is enormous. And you start to get a headache thinking about it. The beautiful thing is it shows up in demand and supply. We could look at demand and supply here and say demand was sort of topped out, but supply came out of the market in the large caps, and we had a very good May. As we move toward the conclusion of May, demand is declining. Supply is fine, but it's certainly not declining. If you shifted to tech and just looked at the tech sector, and that's all I'm showing. It's 30 days of demand, an algorithm saying, let's take every known input that affects trade executions under the regulations and normalize it to a 10-point scale and see how it changes over time. And then compare that to the Reg SHO Rule 201 data set called short volume. What's happening? Well, you could tell in this period from the beginning of May all the way to May 21, this was a really strong period. What happened May 21? Well, May options expirations concluded. And what began to happen? Demand began to deteriorate and supply began to rise. Now, it's not catastrophic. It's why I say I look at the market and say there's nothing wrong. But there's the answer to the question. Why are stocks not soaring with tariffs at least held in abeyance for a period of time, if indeed that's the problem? And all that movement outside of market hours, those are automated systems governing the insurance part of the coin. News hits, the automated trading systems are designed to do things, buy and sell futures. So the market shoots up overnight. But in the underlying equity asset class, we know this condition is developing. And that's why I say you can't trade price. Price is a consequence of something else that is occurring that is predictive. And that's what we are concerned about. And there's your answer. There's a movement related to insurance, but the conditions in the equity class are deteriorating. Doesn't mean they're going to fall apart, but you could go look at the XLF, and it's flat today, but it was way up. Right? And how did it go from here to here? And if you look at CRM, is it going to try to close the gap? Probably to some degree, sure enough. So it moves opposite at the beginning, but it's closing. This is all part of the arbitrage mechanism. If the principal purpose in the market is to keep a basket of equities and ETFs that track those and derivatives that are associated with both heavily used to protect against the unknown, and we're in a period where there's a lot of that, then you will see things move together and move apart. And you don't have to overthink it. There's a good thing about edges. It will do all that for you. It's not perfect, but it will certainly tell us what is occurring. And now, and going to what you observed, this is what we're talking about. So from April 24 to present, we have been above the red line. That's a very long time. You can expand the data set out the entire period, and now it gets very difficult to see. But it is, when has that occurred? Well, not very often. You could go back. This was a very long stretch here. And this was coming out of a heavily currency-driven move in the markets. And we've had a couple of others that were pretty long. But statistically, this is it. So that, if you looked at what happened in the past, you just don't, you don't know. What happened in the past does not mean that it will happen again in the future, which is why everything in the investment industry is qualified with the phrase "past performance is no guarantee of future outcomes." All you can do is learn from the past. But you can certainly see where we are. The long-term trend on the supply side continues to rise because there isn't enough product. The number of public companies continues to be very level. There were 3 or 4 or 5 IPOs today. The problem is they're tiny little things. 2 of them were SPACs. One was a Chinese zipper manufacturer. I see that data. I see all the stuff coming out of the exchanges, and you add them all up, and they're not even 400 or 500 million of market cap, all added up. And so there's the problem for the market. There isn't stuff coming into the market that becomes another Salesforce or whatever. And so what replaces it is a steady increase on the supply side. And these are the things that we have to be aware of, and this is what we can take advantage of. So when those conditions are very predictable, here, you can say, well, supply was very constrained. It's going to be a more volatile data set, but you take the trend was very stable in here, and demand was very strong. We're going to have a great opportunity to trade momentum, and you can see it begin to break down. So here, this is, I mean, to me, this you have a tremendous disruption to the risk management side of the coin, the derivative side of the coin. And it creates great runs and stuff. It creates sharp spikes on the supply side as risk, people try to mitigate the risk and exposure. Everybody can't be on the right side of the trade. So I look at that, and we'll talk last about what that means next. But here I'm going to talk a little bit about how I trade this directionally. May 21, I have $200,000-ish trading account, and I mean, I could make $10,000 on the 21st by being aware of these supply-demand imbalances, and I'll show you what I mean. It always comes back to BCD. What is the broad market doing? What is the context? What tradable events are occurring? That's why these tariff things are so challenging. They're unknowns. We don't know when they're going to happen. In any volatility trading model, there are three core things that one must know: price, volatility, we track those, price and volatility, and time. And that's, these square little squares here, those are events where the time frame is known. Now you have all three legs of the stool. So if options are expiring, demand is way below the green line, and the price then just becomes the mechanism where you're going to buy and sell something. Supply is low. What is the probability that the market might rise from here? Very high. This is why Brian and I both did big levered long trades here, because the conditions were very conducive to that. Here it has gotten more challenging, right? To balance what you do. How would you know whether to? So yesterday I continue to think that this market could produce a very significant downward move. I may be wrong, but we've seen volatility introduced back into the equation. Happened with volatility expirations, VIX expirations right here. But you have to, so you're making a decision about how you're going to bias your trade. I like to do it like I bought $50,000 of IVV market on close yesterday. That is, I just put in a market on close order. I want to fill at the last price of the day. Because you look at this and say, well, why would you do it? The market looks like it's going to fall apart because I don't know what's going to happen overnight, right? you don't know, so you have to have some protection. And then volatility. You should only trade volatility at inflection points. Could you trade volatility here? Yes. Could you trade it here? Yes. Could you trade it here? Potentially. Because these are known points in time where you could add in a long or short volatility play. So here you would put in a short volatility trade. Why? Because when demand increases, volatility tends to decrease. Why? Because there's the spread between the bid to buy and the offer to sell. In a down market, it widens and increases volatility. In an up market, it narrows. So volatility decreases. So you have to be aware of those things. But that's the calculus here. Knowing that tomorrow are month-end options expirations, demand is returning to the red line. It's still very strong. There's no certainty that the market is going to decline. I don't know. The supply side is very high. This little divot here, that gave us this, right? When you have even as high as it was, the fact that we had declining supply gave us a really nice boost to prices. And so we certainly don't have that at present. We have this. So there, I'm going to keep my long short positions, so I'm prepared for whichever direction it goes. And I probably will have a volatility play. That's riskier. As I always say, you don't know with, sorry, let me admit folks here, what's going to happen. And then when do you get rid of one? So when the market popped here, also on tariff news, I had a leverage long, leverage short. I'm losing money on the leverage short that day. So when the market was up, it's all of its volatility for the day, 2%, I sold the long side of the leg. You say, well, now you're unprotected. Yes, but I know what the underlying conditions are. What is the probability it continues? Low. Doesn't mean it won't. Right? So sometimes the probabilities just don't work in your favor, but that's how I do it. I always come back to this. What's the demand supply condition in the market? Is there a thing that gives me a time, date, stamp certain? And if the market moves all of its volatility, S&P 500 tends to move 2%, SPY tends to move 1, momentum moves 3, 1, 2, 3. Those things get distorted during great periods of disruption. That's how I approach it. And you could look at your portfolio and say, well, I'm down on my long leg. Yeah, but you take your profits on whichever side it's going. And does it always work out? No, but it tends to. The volatility trade, that's the risky part, where you can have consequences. Um, Another thing I want to point to here really quickly, and interrupt me at any point. No, there are central tendencies. It's not a perfect timing. I like to do things in the last 10 minutes, a lot of liquidity, likelihood of a good price for whichever direction I want to go. And I haven't risked the entire volatility of the day. What I do risk is what happens overnight. And there clearly we're in a risky period here where you just never know. But that's why you make sure that whatever you're doing, you're protected. If the market's going to move sharply down on you, profit on your short leg. If the market's going to move up sharply on you, yes, it'll cost you on your short leg, but then take the long side. That's what you can do, and you have to always think about this as a tactical opportunity presented by uncertainty. But you know the demand supply balance. Here's the demand supply balance in SPY. It's not predictive. It won't tell you what's going to happen. I do think this is a telling condition. Lot of supply in the market, but again, I think for creating shares to meet the demand of the market, and it stopped at May options expirations. There's been some covering, but that now is diminishing, and demand is coming down. Are we likely to? Could we drop to 1 again? Well, that's going to be very interesting to see. As we've long said, I don't believe that the conditions have changed. I think that we remain with general market structure conditions that could become this. This is 22. May 22, we had very strong moves and difficulty. And we've had these 2 sharp drops to 1. We haven't had that since 22. There were also very strong spikes in demand. That happens. Now, I don't know what happens next. I know supply is very high. So that's why I think that you just have to be aware that no matter how much we hear everything is awesome, the data don't support that thesis. I am not negative on it. All I'm caring about is there a way to profit on this, right? That's what I'm focused on. Okay, so I'll pause briefly before I get to the last couple of items here. Thoughts, comments, questions? Anything? Barry, you look reflective up there.
Yeah, I've been surprised by this market, and as I kind of read the market structure tea leaves, the thing I find fascinating is, yes, the market's been going up, but in terms of volatility, it's getting complacent. And what I mean by that is when I look at the momentum portfolio with 7 components,
Right.
and then I look at the inverse momentum component, that has only 10 components in it. So I'm seeing kind of a flat line on both. And at times in the past, that tells me there is complacency, that no one's really prepared for what may happen. Perhaps not tomorrow, but I think definitely next week is going to be a challenging week. Seasonality is not great in June, but the market structure tea leaves are telling me be cautious.
Yeah, that's a good assessment. Yep. Feel the very same way. You can't. It's hard to get a good direction out of it, right? That's the issue, which is why you have to be careful about. And hey, Barry Bailey, you got a comment? You want to jump in? Go for it. No? Okay. You have to be careful about
No,
the
the
volatility play.
only thing I'm thinking is we should start a taco ETF. With the with the way the trades
That's
are, people are making a killing on the taco stocks. Basically, maybe we need an ETF. You have any connections?
you, I actually do. Yeah. Right. That's one of the core things. Can you, that these people in the ETF business will say it's not your performance that matters as much as can you market it. And a taco ETF, you could raise $1 billion for that overnight.
That's what I'm
You're probably
thinking.
right.
Yeah, well, then we wouldn't have to do this 2% thing every day.
Right. Let's see. David and Candace, let me get to your questions. Do you use leveraged instruments in your long short trades? Yes, I do, David. Now I didn't use my hedge yesterday was just plain IVV. I didn't lever it because I looked at the rate of decline on the demand side and the level of supply in the broad market, and I thought no matter what blows up overnight, it probably won't have staying power because I'm looking at the condition and the underlying asset. Now, I could be wrong, right? So, but if I don't have that certainty, I absolutely do use leveraged instruments. I will just, for general illustration, say SPXU, SPX L. So they're 3 times levered S&P 500. Why those? Well, they're very liquid. They're predictable. And again, am I a huge fan of ETFs? Look, they extend access to the same underlying asset. And in this case, it's a levered extension. But in all mathematical studies of returns, leverage plays a key role. It's an important feature, and it's a way for us to do that. I mean, otherwise you're going to borrow money. That's what the hedge funds do. I've got $100 million and I go to Credit Suisse and borrow 800 million and I put 900 million, right? That's what they're doing. So yes, I do. Be careful about leveraged volatility. Again, I'll say that can cost you because the VIX can lose 4 or 5 points like that. And if you're in a leveraged volatility play, all of a sudden you're down $15,000, right? And you don't want that to happen to you. So on the other side, it's really it's a very easy, stressless trade where all you do is bias your long short based on the demand supply balance. If supply is falling and demand is rising, you lever 3-to-1 long. So SPXL, I'll buy whatever. I can't remember the price of it, just for round number purposes, 300 shares of that, 100 shares on the other side. And as those things, and then you take your gains and you repeat, wash, rinse, repeat. And as the supply demand balance changes, now you change your balance. Then if there's volatility, sell the leg that's profitable and then reset it. And as they converge, now you're going to shift to SPXU and a much smaller hedge in SPXL. Again, it's not perfect, but the beautiful thing is no matter which way the market goes, your loss is minimal and you can sleep because it doesn't matter if the market shoots up or down. You're going to win either way because you have a choice. You don't have to sell your loser, sell your winner, particularly when you know the conditions in the market. That's the whole point. I'm going to come back to this. The whole reason, if you were just making that up every day, you look at SPY and you're like, well, the price was up 2% yesterday. What do I do today? Well, how would you know unless you can see the demand supply equation? That's the whole point. This is the predictive element because you are observing everything that everyone is doing. And so this is an extreme outlier where we've had tremendous, I call it a long contrail. We were a rocket ship coming out of here, and it carries quite a while, the effect of inertia, before it returns to ground. But it could be a pretty violent reentry. I think it could be. Now, so I will take a few more chances going into the close today that there could be a volatile event. By the way, I'm going to be on Schwab TV, Schwab Network tomorrow at 11:30 Eastern time, and I'm going to talk about market structure. So we'll see. I said it could be a volatile day. I'm not saying it will be, but if I look at the data, it's possible. Okay, Candace, did I answer you? I don't think I answered your question. Did I? Let me stop sharing and make sure I did. Whether to go long or short. Okay. Right. Okay. So And if you're not comfortable, do it small. You could do like SPY, and I think, isn't it SH? SH would be just a short trade. And you could do it very small. So you get comfortable with it. I always say aim small, miss small. You have to become comfortable. And I practiced and practiced and practiced because I know data. I'm a data analytics guy. And I've been studying, 20 years I have run Modern IR, studying market structure. But I have to learn too. So you have to take the time in the saddle to do it and find out what things work. And I'll share with you my own experience. I can tell you, you can make and lose a lot of money trading volatility, but you trade leveraged long short instruments that are liquid based on demand and supply when the conditions warrant it. It's very effective and it's peaceful. You can sleep at night. What do you base the exits of your hedges on? It's volatility, right? It's that simple. If the volatility, as Barry says, has come out and the market moves 0.5% in a leveraged instrument, that's going to be 1.5%. If I can get, as I did on whatever day it was it Tuesday? Tuesday, the market shot up. So the S&P 500 was up basically 2%, 6% return in my leveraged instrument. So I looked, and the point in time in the day where the market was up 2%, I sold that. It's volatility that determines the entry and exit for those kind of plays. It's different than a percentage gain in the daily trading ideas where you're after 2%, that kind of thing. Okay. Did I miss anybody? Sometimes I do. Okay. Tim, how do you juxtapose 106 stocks and 75% short with only 7 in momentum, and yet we are not falling? I agree, right? And how is that occurring? That it reminds me of the Sherlock Holmes adage that I have used often, that when you eliminate the impossible, then whatever remains, no matter how implausible, is your answer. And if the market can be stuffed with instruments that are very, very short, and yet the market continues to do fine, although Barry Norton points out the inverse of the momentum portfolio doesn't show that same percentage. To me, it speaks to tremendous stress in the risk management side of the coin. I spend a lot of time thinking about that I think about what I do as a trader, and then what happens if it moves, or as my wife Karen said, what if you have in your basket as an ETF a set of stocks, and you're supposed to have Ford in it, but you don't, and then Ford shoots up, and a bunch of people sell the ETF that is tied to it because, man, the ETF shot up. And so then the intermediary, let's call them Jane Street, buys ETF shares from all those sellers and turns around and gives it to BlackRock or whoever and says, give me Ford. Well, what do? Now it doesn't really work that way. BlackRock gets to determine the composition of the basket, but what it really means is BlackRock's going to have to come up with it. So they're going to have to borrow, or they're going to have to sell something. And I think that's what we're seeing playing out, Tim. I think that is a reflection of the protection people have taken out and the tremendous strain on that protection. That's why, again, I could look at the VIX expirations and say, we could get clocked. If that is true, if that thesis is true, this could be a volatile day. Dow dropped 800 points, remember? And that's why I look at tomorrow and say, look, it might not be anything. People will go to any lengths to avoid losses, but it will show up at some point. And so could it be there? Could it be June? Quarterly index rebalances will have all the last of the annual reconstitutions of the Russells. From here on, they're going to be semi-annual. They've gotten too large. They create too much volatility. That's all happening in June. June 30 be the end of the first half, end of the quarter. All of these things I don't know, but that to me is the answer to your question. Yeah. Okay. Last thing is what's next, and we'll wrap this affair up. And of course, you could already draw your conclusions about what I think is next. What is the probability that we drop below the red line? Nearly 100%. Actually, if we take a daily read of it, and then we average it. There's no statistical difference in the outcome, but behind the scenes, we can see it. The daily read today in this is 5.1. It's not 6.1. It has dropped very rapidly. So, could we on a daily read, we could be negative tomorrow. So I would say the probability we drop below the red line is very high. Does that mean anything? Not necessarily. Is the probability that the supply side continues to rise or falls? Well, I don't know. These things tend to run in 5 to 10-day cycles. I would look at this and say probably it continues to rise. If those are signals telling us what all of the motivation of all of the money is, barring something that we just can't, I don't know what else it is, but there certainly could be something, and I'm going to be protected at the end of the day, as I always am. But I look at that and say, I once again assert that there is downside risk in that data, not because I want to, confirm the bias in my short leg. I've got both. It doesn't really matter to me. But I look at that data and say, I can't come to the conclusion that I'm going to lever long into that. That's where I arrive, particularly month end. Got all this money, trillions of dollars that needs to be tracking the benchmark. And somebody's going to have to do that. And do those somebodies, did they lose money? Well, if they did, if you're an insurer and you have to pay out a bunch of claims, you're going to have to raise capital or sell assets. And the very same principle applies in the stock market. I think the risk is to the banks and the people to whom they sell risk. I used the former CEO of Goldman Sachs years ago during the financial crisis, Lloyd Blankfein. He testified to Congress. He said, Goldman Sachs is in the risk transfer business. That's what we do. We help parties offload risk. So what does that mean? Well, it might be BlackRock who would say, we are concerned about the volatility risk to our portfolios, and we would like to have some insurance on that exposure. And Goldman Sachs will say, we will structure you a basket of options and futures that will protect you in this range, a cap and collar, against any movement. And then they will turn around and sell that risk to somebody else, like an insurer or a hedge fund, who will in turn make some adjustment in their portfolios. All that stuff in a rapidly moving market, somewhere in there, something will break. And this is what it will generally tell you. This would tell you down here, supply way down here, way below trend, the demand side drop way below the green line, it's going to break to the upside. Here, there's not a clear indication, but I look at this and say, I would think it's going to break to the downside. Let's expand out a little and then we'll stop. Be the last thing. If we go back to, what happened earlier in the year, what could you conclude? Well, the market peaked here and you look at the supply side and say, wow, well, that's probably going to decline. It took a little bit. It took till options expiration. So again, I would look at that and say, those were people trying to ride it out till they got to expirations to recalibrate their derivatives positions. But clearly they took some hits and then the market dropped sharply. And then it doesn't really get its footing until we get to options expirations again. But the supply side tells you there's a real battle to figure out who's on the right side of that trade. So we get some recovery, and then we get to options expirations, and the market falls apart. Yes, there were tweets and tariffs and changes, and we had juking and jiving policy. But that is information inputted into the insurance exposure people have. Now, certainly that has calmed down, but I don't think the risks have gone away because the losses have not been mitigated. So I look at that and say, just be prepared. Whatever you're doing, difficult to have a committed trade directionally here. If you do anything, to me, it's long short with a bias to the short side. That's where I am. And that's why. I could be wrong. So that's what I've got for today. That's plenty. That's enough to drive you to drinking right there. Okay, have I missed anything? If not, the borrowed shares trading between... Well, certainly intraday, Tim. That the former CEO of Bats told me, which is now SIBO, and I sat in his office in Kansas City. It's in Overland Park. He said there are different purposes and time horizons. And you have to understand that. So, yes, for the Jane Streets and Citadels, their purpose and time horizon is intraday trading. That's what volume is. Volume is the same shares moving over and over and over. And by the end of the day, they don't want to own any of it, which is why there's so little settlement data. I'm on a panel, by the way, Monday with the guy who runs the data products at the DTCC, very good friend of mine. I coerced him into doing the panel with me. But we talk about this all the time because they clear and settle 98% of all transactions in the US market in everything. So they see all that stuff. So that's what happens there. But then what happens how do you know? If whether you've got that kind of stuff? Well, it all works out ultimately because there's a value at risk food chain. But what I'm saying, Tim, is there are some unknown risks in there that I can only surmise by knowing the three main components: equities, ETFs that track those equities, and derivatives that trade on both of them that people will use for directional bets and for insurance.